Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode number 22 on August 11th, 2018. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Zillow Group, Caterpillar, MetLife, and GoPro. And we will also look at 3 or 4 new trades this week. We're looking at trades on Yelp, Dillard's, the IWM ETF, and Abercrombie & Fitch. So I hope you enjoy this episode. It's always great to hear from listeners as well. If you have any questions about the trades presented here or about your own positions, feel free to email me. You can reach me at ERIC, that's Eric at theweeklyoption.com. And I've also created a short video series to teach you all the basics of option trading that you'll need in order to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch those videos, or you can also find them on our YouTube channel for theweeklyoption.com. Now, the world is still, as far as economic news, this past week, we're seeing that the world is still very much watching all of the news from Washington, D.C. The tariff discussion has really been quite incredible. You can see that the proposed tariffs are having a significant effect on the global economy, affecting the flow of goods and services as well as the flows of capital. And on Friday, just yesterday, we saw Turkey's currency have a 20% sell-off based on one tweet. I mean, imagine that. A tweet causing the currency of an entire country to crash 20%. And not even on proposed, but on possible tariffs. So maybe we should start talking about, maybe I should discuss currency options on the next podcast. Certainly have been looking at cryptocurrency lately as well. I haven't decided how I want to address that, but those are a couple of the options that have been on my mind. Now, that being said, if there's ever a company or a topic that you specifically would love to hear me address, just let me know. Maybe I'll do some research and take it on, or you never know, it might be something that I've already been researching on my own, but just haven't spoken about in the more public podcast just yet. Now, after 5 consecutive weeks of slightly higher values each week in the market, we finally are seeing a week of slightly lower prices. Both the Dow and the S&P 500 finished the week less than 1% lower. The Dow Jones Industrial Index finished the week 149 points lower, closing at 25,313 points. The S&P 500 index declined a whole 7 points to end the week at 2,833 points. So slight movement lower actually. And as far as earnings, we've made it through the busiest weeks of quarterly earnings. I mean, we've seen 1,100 plus earnings per week over the last few weeks. This week there are fewer than 300 companies posting quarterly earnings, and here are a handful that I'm going to be watching. So on Tuesday we'll hear from Home Depot. On Wednesday, we'll hear from Macy's. On Thursday, we'll hear from JCPenney, Nordstrom, and Walmart. And then on Friday, we'll hear from John Deere and Company. And that's really an interesting bunch. Both Home Depot and John Deere are truly going to be affected significantly from all of the tariffs on steel and other commodities that have to do with, home construction and any industrial. John Deere is a premier, possibly the biggest, I'd have to do the research, creator of tractors and equipment for farming. And Home Depot obviously has a significant reach when it comes to building and manufacturing. And then we're also going to hear quite a bit from, retailers this week: Macy's, JCPenney, Nordstrom, Walmart as well. A little different, but similar, especially with school, both college and K through 12 getting started here in the next few weeks. You should see people spending their money buying their kids new clothes for school and new school supplies. So it'll be interesting to hear how their earnings are received, or see how their earnings are received in the market this week, especially as most or several places are having tax holidays for sales tax to incentivize consumer spending. So that's it for sort of our little update. Let's look at the trade reviews. Let's look at last week's trades. So our first one was a covered call on Zillow Group. And when we looked at it, Zillow Group had finished the week at $58.25. And we were looking at selling the September 60 call for $2.70 with a goal of a 7.64% in return in 6 weeks. Now, this trade is the perfect example of the dangers of the covered call option. So Zillow stock announced earnings on Monday. Now, the fact that we were looking at a trade before earnings week, like the week of earning, made this trade inherently more risky anyway. I didn't realize quite how risky, but the stock, Zillow stock announced earnings on Monday evening after the close, and the stock was trading around $59 at the end of the day on Monday. So at the end of the day on Monday, it's $59. It had risen, 75 cents from Friday. They made their announcement. The stock opened the next day $10 lower. So if you own Zillow stock, there's really nothing you could do to protect yourself from that fall, a $10 gap move. Sure, if you sold that call, you've earned $2.70 on the option. Really, that option right now can be purchased for 30 cents. So if you were to close that trade, you've collected you've made $2.40 on the option, but really $2.70. But at the end of the day, you lost $10 on the stock. So many of you won't understand, but I've always looked at covered calls as being one of the riskiest trades I present in each week's show, even though it feels the safest. It feels safe because you're pairing stock, which most people are familiar with investing in, the ownership of stock. You're pairing that stock with selling an option, and everyone knows that something like 60 or 70% of options finish worthless, finish out of the money. So you take that concept, you pair it with something and it seems safe. But the reality of it is the money you collect from selling that call option isn't always enough to cover the possible downside that you can end up assuming on the shares of stock you own. So in this situation, yeah, the option worked. Congratulations, but you actually would have lost significantly more on the stock options. On the shares of stock that you own. So the spread trades that we execute each week, the ones I'll cover here in a minute, have limited risk and a known upside. So that tends to be how I focus on allocating my capital. I don't like the idea of going to bed happy on Monday and waking up Tuesday morning wanting to, punch the wall or something because, my stock just went down, $10. That's a significant move. So, I did not put this trade on. I hope none of you did. But if you did, there are still other options you could take on. So what do you do if you take on what would that be? $7.30 loss, right? Per share. Well, we're in a new month. We're in September. You can always look at selling some out of the money options to the tune of that $7.30 per share. You can look at companies that are similar to Zillow, seeing if there's maybe a spread that you could put on next time to offset, one where you're long one company, short the other. So really, you're just trading the differential. There's some things that can be done. You can look at selling put spreads, like we look at later in the show. You look at selling call spreads. You can look at ratio spreads and all sorts of other things to try to recoup from a $10 gap move in the stock. But man, it's hard to cover that. That's a big one. So this was definitely a loss for the week. And we'll get into the second trade. Our second trade last week was a credit spread on Caterpillar. At the time, Caterpillar was trading for $138.51. And we were looking at selling the August 138-137 put spread, collecting 34 cents, and knowing that we have a maximum loss of 66 cents on this spread. So this is ding number 2 for last week. Last week just was not the best week for trade ideas. So this is ding number 2 for last week's trades. Caterpillar finished the week $3 lower. So our out of the money or even at the money put spread that we sold is now in the money. And unlike our covered call, we knew from the start our maximum loss, knew it was capped at 66 cents. So we sold $1 spread for 34 cents, leaving a possible loss of 66 cents. And to buy in that spread today would cost us 85 cents, leaving a loss of 51 cents on the spread. So we definitely lost money here. You could sell the August 138, 139 call spread against it. So still in August, 1 week left, for 19 cents. And as we've discussed in the past, if you sell a higher strike call spread, there's no way for them both to finish in the money. So that would increase the total amount of money we've collected to 49 cents and lower our total possible loss to 51 cents. It would also lower the current loss on this trade from 51 cents down to 32 cents if you were to also execute, selling that call spread, the 138, 139 call spread, against this put spread, which you're already lost and it's already costing us money. So, if prices stay where they are, our 138, 137 put spread will be worth $1 by the end of the week, guaranteeing a pretty solid loss. We are also well below our break-even point. So for consistency's sake, I would close this trade and take the 51 cents loss. This was also, it's an August trade, so you don't have a whole lot of time. The likelihood of regaining some of the value of this spread is really unlikely because the clock is ticking so heavily. Only 5 business days left until expiration. Now, the one shining moment we had this past week, and I actually presented 4 trades last week rather than 3, so I looked at MetLife. MetLife, symbol MET, Mary Edward Thomas, was trading for $45.33, and we looked at buying the August 45 half 46 put spread for 30 cents with the goal of collecting 20 cents or roughly a 66% return in 2 weeks. Now, finally, we can get a trade that is winning because Met stock, the MetLife stock is actually down 68 cents, meaning our in the money put spread that we purchased is even more in the money now. If we were to close the position right now, we would sell it for 34 cents, and that's really just because of the having to cross the bid-ask spread. That would mean even with that, having a 4-cent gain on a 30-cent outlay is still a 13% return in 1 week, so it's not bad. But remember that this is an August trade. We were looking at the August 45 half 46 put spread. So because it's an August trade, if price stays right here for 5 more days or even goes a little lower, this spread will close on Friday with us having made 20 cents, right? We paid 30 cents for a spread that could have a maximum value of 50 cents. So if we hold on to this trade, we'll pick up the other 16 cents in this spread and, for a total of a 66% return in 2 weeks, risking our capital for 2 weeks. So this was our shining moment. This trade actually made money this week. Let me talk about our final trade, which was not quite so beneficial. So we looked at GoPro last week. When we looked at it, it had finished the week for $7.05. And we looked at buying the 6.5-7 call spread, paying 35 cents with the hope of collecting 15 cents or a 43% return in 2 weeks. Now, like I said, this is our third ding for the week. GoPro stock fell $1. The stock fell 15% in 1 week. So our in the money spread, this call spread that we purchased, is now completely out of the money. We've essentially lost the 35 cents on the spread, and I would honestly look at closing the spread and walking away. Or, honestly, just leave it. Leave it on just in case the stock rallies back over the next week. The spread is currently priced at 1 cent, so no point selling it for a penny. I've essentially lost the 35 cents that I paid on the spread. But because I bought the spread and we've seen how volatile this stock apparently can be, If the stock swings back over the next week, it could end up, inking out a little bit of a profit for us. So, you know, this trade is essentially finished in a week. So win or lose, 5 more days, I'm going to hold it. I mean, it essentially can only go up. It can't go any lower. The beauty of buying options, and so a debit, when I talk about debit spreads, those are spreads that we actually purchase. So the beauty of buying a spread is I can only lose the amount of money that I put in the market. So I put in $35 right now. I'm not getting. I'm really only getting $1 back for it if I were to try to sell it off. So might as well hold on to it and see if the stock swings back in our favor. I've seen, trust me, I've seen a lot crazier things happen. So that is it for the results for last week. It was kind of a painful week, but it's the reality of trading. You're going to win some, you're going to lose some, and that's why I like to make sure that I'm trading spreads, and I'm using what I know about options in order to create scenarios that have high potential for me to win. But if I lose, and really I should say win, because it's never an if. Like, it's when you lose, you want to make sure that it doesn't cost you a whole lot of money on a percentage basis. You never want one or two trades to sort of make or break your entire portfolio. So money management, and I don't talk about that much on the show. Probably should. I talk about it in courses that I've created, but money management is huge. It's all about how you spend, how you allocate your risk capital. And again, these are options. We're talking about placing trades every week. So this is definitely risk capital, not necessarily long-term investment, right? So that's it. Let's take a look at the new trades for this week. So we're going to start off with that covered call. And after getting destroyed with the Zillow trade last week, I figured I would offer up 2 more conservative covered calls for this week. Now, both companies announced earnings last week, so I don't anticipate any significant price gaps from these companies. So it should be a little more conservative. And we also are looking at September trades. All of our trades this week are September. In past months, I have always looked at sort of some 1 week long trades in expiration week. This week I don't really feel like doing that, especially after taking a couple of hits on my trades last week. So I'm going to go ahead and jump out to September. So we're looking this week at Yelp. Yelp announced earnings last week and had a decent little run up in the stock. The stock finished on Friday trading for $49.35. And we are looking at selling the September 50 call against the stock that we already own. And we would be collecting $2.15 per share for each option that we sell. Our goal here, this will put us in a position if the stock increases 65 cents and we see Yelp finish higher than $50 at the end of September expiration, which is, I believe, September 17th, something like that, we would get a roughly 5.5% return in 5 weeks. So that's fantastic. And our second trade is going to be on Dillard's, the retailer. Now, Dillard's had also announced earnings last week. So, and this stock is a little higher than what I normally would suggest. I normally try to keep the covered call strategies at around $50, the stock price being around $50. The reason I have typically done that is I want to make the trade ideas that I give on the show affordable for just about anyone. So, if you were to have 100 shares of Yelp, for instance, which is $49.35, 100 shares of that is just going to be $4,935. And then you're going to turn around and collect, $215 for every option that you sell. So honestly, you could put this trade on for less than $5,000, a little less than $5,000, and still run the possibility of collecting, and still have the possibility of collecting a decent little return over the next 5 weeks. Dillard stock right now is trading for $85.83, so it's gonna be a little bit more expensive if you don't already own the shares. And I'm looking at selling the September 87.5 call for $5.10. Now, whenever I see significant significant premium in an option like that, especially an option with so much time left to expiration, I'm a little bit cautious. So if this stock raises, just shy of $2, if it's up about $1.70 over the next 5 weeks, then we're gonna see a 8% return for this stock and option combination. So 8% return in 1 month is unusual. So you have to dig a little bit deeper and make sure you know what's going on with this stock. But certainly the $5.10 that we collect for selling this option creates a nice price cushion in case the stock goes lower. What could make it go lower? Well, I told you earlier that we're going to hear from JCPenney, Nordstrom's, who else? Macy's this week. These are their peers. These are peers or competitors of Dillard's. And if we see poor earnings on their part, then I assure you Dillard's is going to fall with it. So, always be a little cautious. If sometimes options are priced high, mostly because of a large amount of volume at that strike, and that could really push the volatility of that individual strike higher. But as well, typically if a stock option is priced high, there's normally a reason for it. You're being paid for the risk that you're taking on. And so I want to make sure I understand that risk as much as I possibly can. So, just a little bit of a word of caution in case you do end up looking at this Dillard's trade for your portfolio. Now, the credit spread I'm looking at is on one of my favorite ETFs, IWM. That's the ETF for the Russell 2000 Index. And again, that's Isaac William Mary, IWM. The index finished, or the ETF finished on Friday for $167.53. I'm looking at selling the September 169-170 call spread and collecting 44 cents. So this is an out-of-the-money call spread I'm looking at selling, mostly because IWM has been pretty high. It's been strong and kind of channeling. To me, it looks like it's losing momentum, so I don't mind selling this call spread a little bit higher. We have a maximum gain, of course, of 44 cents, the amount of money we receive when we sell this spread, and then a maximum loss of 56 cents because this is a $1 wide trade. So there's plenty of time if things do go against us, plenty of time to also sell a put spread against it if this trade moves in the wrong direction. Like if price goes higher, I'll be looking at selling a put spread against this too. Or we always have the option of buying in our spread and just rolling the strike to a more at the money strike so that we collect a little more premium and offset any losses. So again, these are September trades, 5 weeks left before September expiration. So we'll have plenty of time to make additional decisions if the trades aren't, immediately for us. Final spread today, we are going to look at Abercrombie & Fitch, symbol ANF, Apple, Nancy, Friday. Stock finished on Friday for $27.14. We are looking at paying 60 cents for the September 26-27 call spread. So that's going to give us a maximum gain of 40 cents when this trade expires, being worth fully $1. And that 40 cents on a 60 cent outlay of capital actually equates to a 66% return in 5 weeks. So here are a few things to keep an eye on with this trade. First off, they have earnings on August the 30th. So that's a little, that's a date coming up that you need to be aware of. If they have great earnings, this trade's going to be phenomenal. If they don't have great earnings, you might want to have an idea of what else you're going to do to offset any possible losses, whether that means selling call spreads or what. You'll have another decision to make. So earnings on August 30th, an uptick. They should get a nice increase in uptick in sales with back to school shopping here over the next few weeks. So that could be a positive. And they recently started accepting Venmo as payment. So to me, that's a sign of trying to remain relevant to their target age demographic. A lot of the youth of the world are more comfortable with payment with electronic and online payment solutions. So it's great to see Abercrombie & Fitch make this move as well. Really, I just want the stock to stay where it is or go higher. Just don't come lower so that we can collect 66% on our risk capital over the next 5 weeks. So that is it. I hope you guys enjoyed the show. Again, if you have any questions, feel free to email me, eric@theweeklyoption.com. Looking forward to hearing from you. Have a fantastic week. Happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.